portfolio can become far riskier without the investor buying a single new security. All it takes is for yesterday's winners to grow and quietly take over. This lecture shows how asset allocation, portfolio drift, and rebalancing determine the risks investors actually own, and why disciplined rebalancing often forces us to sell what everyone loves and buy what everyone fears. This is one of the most important topics in investments because it connects finance theory to real portfolio decisions. A portfolio isn't simply a collection of securities. It is a structured plan for taking risk, pursuing return, meeting obligations, and staying disciplined over time. Asset allocation is the decision to divide portfolio capital across broad asset classes. These may include equities, fixed income, cash, real assets, private assets, and other investment categories. This decision is often more important than choosing individual securities because it determines the portfolio's major exposures. When we allocate assets, we are asking a practical question. What mix of assets gives the investor a reasonable chance of meeting the objective while staying within acceptable limits? Those limits may involve risk, liquidity, taxes, time horizon, liabilities, spending needs, regulations, and governance. So, throughout this lecture, don't think of asset allocation as a simple search for the highest expected return. Think of it as a policy decision. It is the foundation of portfolio management. By the end of this lecture, you should understand how asset allocation sets portfolio direction, how rebalancing maintains discipline, and how different investors require different portfolio strategies. Let's begin with strategic asset allocation. Strategic asset allocation is the long-term policy mix of asset classes chosen to support the investor's objectives and constraints. It is sometimes called the policy allocation or the policy portfolio. The key word here is policy. A strategic allocation isn't supposed to change every time markets move or headlines become dramatic. It is designed to serve as the long-term anchor for the portfolio. A good strategic allocation usually specifies target weights for major asset classes, permitted ranges around those targets, rebalancing rules, eligible and ineligible investments, liquidity requirements, risk limits, and governance procedures. The main idea is simple. The target weights determine how much each asset class contributes to the portfolio's expected return and risk. This is why strategic allocation is so powerful. It decides the main risk profile before individual managers or securities are selected. Strategic asset allocation is also a governance decision. It helps investors decide what risks they are willing to take before market stress occurs. That matters because during good markets, investors may become overconfident. During bad markets, they may become fearful. A clear strategic allocation helps reduce emotional decision-making. It also creates a benchmark for accountability. Once the policy portfolio is defined, performance can be evaluated relative to that policy, rather than judged only by emotion or recent market results. Now, let's discuss tactical asset allocation. Tactical asset allocation refers to shorter-term deviations from the strategic allocation. In other words, the strategic allocation is the long-term anchor, while tactical allocation is the temporary adjustment. A manager may temporarily overweight or underweight an asset class because of valuation, macroeconomic conditions, risk conditions, liquidity concerns, market dislocations, or other investment views. The important word is temporary. Tactical allocation is an active decision. It is based on the belief that the manager has useful information or judgment that can improve the portfolio after considering costs, taxes, and risk. But tactical allocation can also harm performance. If the timing is wrong, if trading costs are high, or if the tactical position creates unwanted exposure, then the portfolio may move away from the investor's real objective. This is why tactical decisions should be controlled by limits. A policy may allow some flexibility around the strategic target, but that flexibility shouldn't be unlimited. The distinction between strategic and tactical allocation is essential. Strategic allocation answers the question, what is the long-term policy mix that fits the investor? Tactical allocation answers the question, should we temporarily adjust that mix because of current conditions? Strategic allocation sets the core risk budget. Tactical allocation uses active risk relative to that policy. A disciplined portfolio manager understands both. The strategic allocation provides stability. Tactical allocation may add flexibility, but it must remain consistent with the investor's objectives and governance process. Asset allocation plays a central role in portfolio performance because it determines the broad risks to which the portfolio is exposed. A portfolio with more equity exposure will usually be more sensitive to equity market declines. A portfolio with more long-duration bonds will usually be more sensitive to interest rate movements. A portfolio with illiquid private assets may face different liquidity and valuation risks than a portfolio invested only in public markets. This is why asset allocation isn't just about return. It is about exposure. The formulas on the screen show that asset class weights affect expected return and portfolio risk. But the deeper lesson is that portfolio risk depends not only on the risk of each asset class, but also on how asset classes move together. That is the foundation of diversification. Diversification means combining assets whose returns don't move perfectly together. When done well, diversification can reduce portfolio volatility, but it doesn't eliminate risk. During market stress, correlations can rise, liquidity can disappear, and several risky assets may fall at the same time. So diversification is powerful, but it isn't magic. Another important concept is risk contribution. Two portfolios may have the same capital weights, but very different risk contributions. A high volatility asset can contribute more to total portfolio risk than its capital weight suggests. This leads to risk budgeting. A risk budget asks how much of the portfolio's total risk should come from each source. The goal isn't always to make every risk contribution equal. The goal is to make sure that the risks are intentional, understood, and consistent with the investor's objectives. Even if a portfolio starts exactly at its target allocation, it won't stay there forever. This is called portfolio drift. Drift happens because asset classes earn different returns over time. Some assets rise faster than others. Some assets decline. Contributions, withdrawals, currency movements, manager cash flows, valuation changes, and corporate actions can also move the portfolio away from its target weights. The intuition is straightforward. Assets that outperform become a larger share of the portfolio, and assets that underperform become a smaller share. This creates a problem. If the portfolio is left alone, it may gradually become very different from the original policy. The investor may end up taking risks that were never intended. That is where rebalancing enters. Rebalancing is the process of bringing the portfolio back toward its target allocation. The main purpose of rebalancing is risk control. It prevents the portfolio from becoming unintentionally dominated by recent winners. It also prevents the portfolio from becoming too defensive after risky assets decline. Rebalancing also imposes discipline. It often requires selling assets that have risen relative to the rest of the portfolio and buying assets that have fallen. That can feel uncomfortable. In strong markets, selling winners can feel wrong. In weak markets, buying assets that have declined can feel scary. But disciplined portfolio management is often most valuable exactly when it feels most difficult. It is important to understand what rebalancing is and what it is not. Rebalancing isn't a guarantee of higher returns. It isn't a prediction that yesterday's winners must become tomorrow's losers. It isn't simply a return forecasting tool. Its main purpose is to keep portfolio risk aligned with policy. Rebalancing can improve risk-adjusted outcomes when assets experience mean reversion, or when it prevents excessive concentration. But it can reduce returns during persistent trends because it sells assets that have performed well and buys assets that have performed poorly. So the right rebalancing policy depends on objectives, costs, taxes, and risk tolerance. There are two common approaches. The first is calendar-based rebalancing. The portfolio is reviewed on a regular schedule. The advantage is simplicity. It is easy to document, easy to communicate, and convenient for committees or advisory relationships. The limitation is that it may trade when drift is small, or it may wait too long when drift becomes large between review dates. The second is threshold-based rebalancing. The portfolio is adjusted when weights move outside specified bands. The advantage is that trading is linked to meaningful drift. The limitation is that the portfolio must be monitored and the bands must be designed carefully. Many investors combine the two approaches. They review the portfolio on a schedule, but trade only when drift is large enough to justify action. A good rule should answer four questions: how often the portfolio is reviewed, what drift triggers a trade, whether the trade returns the portfolio fully to target or only back inside the band, and how costs and taxes are considered. Rebalancing is useful, but it isn't free. Every rebalancing decision should consider implementation costs and constraints. There may be explicit transaction costs, such as commissions, exchange fees, custody fees, or other direct trading costs. There may be bid-ask spreads, which represent the difference between buying and selling prices. There may also be market impact. Large trades can move prices against the investor, especially in less liquid markets. There are opportunity costs as well. Waiting to trade may leave the portfolio away from target, but trading immediately may be expensive. Operational constraints also matter. Some assets cannot be traded daily. Private assets may adjust slowly through commitments, distributions, or secondary market transactions. Taxes add another layer. In taxable accounts, selling appreciated assets may realize capital gains. Selling assets at a loss may create tax benefits in some situations, but tax rules differ across jurisdictions. A tax-aware rebalancing process often begins with the least disruptive actions. New contributions can be directed toward underweight asset classes. Withdrawals can be taken from overweight asset classes. Rebalancing may be done within tax-advantaged or tax-exempt accounts when possible. Selling taxable positions may come later, after considering taxes, trading costs, liquidity, and risk exposure. The key question isn't simply, is the portfolio away from target? The better question is the risk reduction from rebalancing worth the after-cost and after-tax consequences? That is how a portfolio manager thinks in practice. Now let's shift from the rebalancing process to the investor. For individual investors, portfolio management begins with personal objectives and constraints. The objective may be retirement income, education funding, housing, charitable giving, wealth transfer, or general financial security. The portfolio must be designed around both the amount of wealth needed and the timing of expected cash flows. Important considerations include return requirement, risk tolerance, risk capacity, time horizon, liquidity needs, taxes, human capital, and behavioral discipline. A very important distinction is the difference between risk tolerance and risk capacity. Risk tolerance is the investor's willingness to accept volatility and losses. It is emotional and psychological. Risk capacity is the investor's financial ability to bear losses without jeopardizing essential goals. An investor may be emotionally willing to take risk, but financially unable to recover from a large loss. Another investor may have strong financial capacity, but low emotional tolerance for volatility. A sound allocation should consider both. Human capital also matters. Labor income, business income, career stability, and future savings ability can affect how much investment risk an individual can reasonably accept. For individuals, rebalancing can reduce behavioral mistakes. A written policy makes it easier to avoid abandoning risky assets after market declines, or taking excessive risk after strong gains. The goal isn't to remove judgment completely. The goal is to make judgment disciplined, consistent, and connected to long-term objectives. Institutional investors manage capital on behalf of beneficiaries, policyholders, donors, governments, owners, or other stakeholders. Their portfolios are shaped by formal objectives, governance structures, legal and regulatory constraints, accounting rules, liquidity needs, and long-term obligations. A central document in institutional portfolio management is the Investment Policy Statement. The Investment Policy Statement documents the purpose of the assets, return objective, risk tolerance, asset allocation targets, permitted investments, liquidity requirements, spending or liability needs, rebalancing rules, manager selection procedures, and reporting standards. Institutions differ from individuals in several ways. Their objectives are often connected to liabilities, spending policies, or mission-related commitments. Decisions may be made by committees, boards, staff, consultants, and external managers. Performance may be evaluated relative to policy benchmarks, peer groups, or funded status measures. Governance is essential. A policy allocation that looks attractive on paper can fail if the institution cannot tolerate its drawdowns. Explain it to stakeholders, meet liquidity needs, or rebalance during difficult markets. Institutional managers also monitor active risk relative to policy. The concept is simple. If the portfolio deviates from policy, that deviation should be intentional, explainable, approved, and consistent with the institution's risk budget. Institutional portfolio management isn't only about choosing assets. It is about creating a disciplined system for making decisions on behalf of others. Let's finish by looking at several types of institutional investors. Pension funds manage assets to provide retirement benefits. Defined benefit plans promise benefits according to plan rules, so the sponsor bears important investment and funding risk. The portfolio must be managed relative to liabilities, not only relative to an asset benchmark. Defined contribution plans are different. Participants usually bear more of the investment risk, so asset allocation often focuses on participant choice, default investment design, diversification, and life cycle risk management. Endowments and foundations manage assets to support a mission. They must balance current spending with long-term preservation of purchasing power. A key issue is intergenerational equity. Spending too much today can hurt future beneficiaries, but spending too little today can fail the current mission. Insurance companies invest assets to support policyholder obligations, reserves, regulatory capital needs, and shareholder objectives. Their portfolio management often emphasizes asset liability management, including cash flows, duration, credit quality, currency exposure, and liquidity. Across all of these investors, the central principle is the same. There is no universal best allocation. The right allocation depends on the objective, constraints, liquidity needs, risk tolerance, governance process, and obligations. Asset allocation sets the intended exposures. Rebalancing keeps the portfolio from drifting too far from those exposures. Governance determines who can change the policy, how decisions are approved, and how performance is evaluated. Risk control doesn't mean avoiding risk. It means taking risk deliberately, sizing it appropriately, monitoring it consistently, and keeping it connected to the investor's purpose. Thank you for joining me today. I hope this lecture helped you understand asset allocation, rebalancing, and institutional portfolio management more clearly.